Hello, this is Xber. This is my first time formally greeting you in a video like this. Even if there are shortcomings, I hope you enjoy it. My video content will basically deliver stories about disclosure materials 10Q and 10K. First, I'm going to share a Tesla's Q2 story of 10Q. The story order will first cover 10Q's business environment, then the basics of financial statements, income statement, balance sheet, and cash flow in that order. 10Q business environment. Some investors might not know that the companies describe and update business environment in 10Q, 10K. Many investors watch live broadcasts of Fed Chair Jay Powell's announcements and focus on what he says and what changes he makes because they want to get a hint of the future direction. Reading a company's 10Q filing is similar. Companies typically describe the overall direction of the business environment they face, providing clues about potential challenges and opportunities ahead. In the Q2 10Q, Tesla continues to talk about uncertainties in the automotive and energy markets due to rapidly changing trade and fiscal policies. As is widely known, the $7,500 federal EV tax credit, ZEV credits in certain programs, and renewable energy incentives are set to expire soon. These changes pose risks to the global supply chain and cost structures established by Tesla and the EV industry, and they could significantly negatively impact demand and profitability for Tesla vehicles. Additionally, persistently high interest rates are eroding consumer purchasing power, leaving buyers struggling with reduced affordability for finance purchases. And it's true that they are currently struggling with weakened purchasing power due to interest rates. Moreover, such sudden fiscal and trade policy changes could lead to changes in mid to long-term plans. The direction won't change, but the timing might, especially in investment areas. The company continues to mention that part, namely cash flow. Also, before discussing the EV and energy markets, Tesla emphasizes a profitable growth strategy. Plans for affordable models aim to lower costs by utilizing existing processes, ensuring profitability even at reduced prices, while advancements in full self-driving (FSD) features, the launch of robotaxi services in Austin, and the introduction of Cybercab, among others, are driving Tesla's transition into a real-world AI company focused on both quantitative and qualitative improvements. In this context, the company repeatedly highlights negative impacts from government policies on EVs, particularly how the impending end of tax benefits could decrease short-term EV demand, though Tesla plans to counter this through aggressive cost reductions. For the energy sector, changes in tariffs and incentive policies are heightening uncertainty. Yet demand, not just in the current period but over the mid to long term, benefits from positive factors such as energy shortages stemming from AI infrastructure expansion. Therefore, while the reduction in incentives is expected to negatively affect Tesla in the second half of the year, the company anticipates maximizing profitability by minimizing price cuts and launching a variety of models across different price points. On the competition side, they indirectly mention the composition of Chinese EV economic entities. Regarding the intensified competition in the EV market, it's clear that Tesla continuously emphasizes its transition to an AI company. On the regulatory side, as mentioned earlier, they expect a short-term performance decrease due to the impact of the OBBBA bill. In the supply chain section, they indicate that due to tariffs and policy changes, there may be disruptions in immediate parts supply or financial impacts, while also expressing concerns about components sourced from domestic companies facing difficulties. As a countermeasure, Tesla's greatest strength, its vertical integration of the supply chain, is expected to minimize these risks. The overall atmosphere of the operating environment clearly retains lingering uncertainties. The Tesla 10Q filings for Q1 and Q2 2025 reveal evolving nuances in the company's management environment, shifting from a predominantly negative tone in Q1, marked by strong uncertainties from escalating trade wars, a 20% decline in vehicle sales, 7% drop in profitability, prominent performance deterioration amid competition from low-cost Chinese EVs, robotaxi delays, protests, and external factors, despite positive energy storage growth, 67%, and AI opportunities to a more stabilized and balanced perspective in Q2, which highlights response capabilities through a strong balance sheet amid ongoing instabilities like trade changes, fiscal policies, logistics disruptions, and political tensions, with signs of recovery, including a 16.6% QoQ increase in deliveries, despite 12% YoY decline, 14% rise in vehicle deliveries, record energy storage profits, and confidence in long-term growth via AI and robotaxi. While Q1 avoids 2025 growth promises and emphasizes increasing uncertainty in automotive and energy markets due to rapidly evolving trade policies adversely affecting global supply chains and costs, Q2 maintains caution about potential rough quarters ahead, softening the language to sustained uncertain macroeconomic conditions from shifting tariffs and policy changes, yet continues high-value CapEx and R&D investments. Overall, the comparison shows a slight shift from sharp performance drops and demand impacts to improved recovery signals and strategic focus, but challenging uncertainty still dominates, rendering it more of a cautious rebound than a complete pivot to positivity. Now, let's dive into the Q2 financial statements analysis. First, let's look at the income statement. Q2 revenue was $22.5 billion, down 12% year-over-year, but up 16% quarter-over-quarter, showing a turnaround. At the center is the recovery in the automotive business, which accounts for over 70% of revenue. As per automotive business, to minimize the Osborne effect from a new Model Y launch, they shifted from the previous regional sequential production strategy to a new approach of global simultaneous production. As the ramp-up of the new Model Y was completed in Q2 and supply normalized, Q2 revenue was $16.7 billion. This is still down 16% year-over-year, but the rebound to plus 19% quarter-over-quarter revenue is encouraging. Energy business revenue was $2.8 billion, down 7% year-over-year at the previous year's level. However, this stems from the nature of the order-based industry, with the Nevada Megafactory in full operation and Shanghai Megafactory ramp-up progressing normally, so the second half is even more anticipated. Services revenue was $3.0 billion, marking the first time in a quarter to reach $3.0 billion, up 17% year-over-year. To summarize again, the turnaround in automotive business, the even more anticipated second half for energy business, and services revenue expected to grow with supercharger opening. Looking at half-year revenue, overall down 11% year-over-year. Also, what makes Q3 exciting is that automotive business rebound momentum will continue with new launches like low-end Model Y and Model Y EL, supply normalization of the bestseller new Model Y, and Q3 demand. Nevertheless, how to respond in Q4 is clearly a short-term issue. Automotive business growth is slowing due to the rise of Chinese EVs and external conditions, needing a structural turning point. In my personal opinion, affordable models or Model YL are temporary measures, and a phased shift in automotive business seems needed through FSD subscription rate increases, robotaxi expansion, new form factor cybercab launches, etc. I understand why Elon strongly pushed autonomous driving and cybercab. To gain a complete competitive edge over Chinese EV companies, they need to preempt what others don't have. The energy business has just entered a high-growth phase. Q2 looks a bit sluggish, but on a half-year basis, this year's first half revenue exceeded last year's second half. Moreover, this makes the second half even more anticipated. Furthermore, the Shanghai Megafactory ramp-up is expected to be completed, establishing 2 production axes with Lathrop. While services revenue growth continues, the second half is anticipated as supercharger opening effects kick in fully because of considering higher supercharger utilization from summer to year-end. This slide is the trailing 12-month rolling revenue, meaning looking at revenue over the last 12 months to minimize fluctuations due to seasonal factors or order timing, allowing a clearer view of revenue growth trends without distortion. Automotive growth is declining, but it's partially offset by high growth in energy and services. Next is the accumulated revenue status by business. Automotive's curve is starting to flatten a bit, but I hope a rebound occurs in automotive through FSD and robotaxi expansion. We've looked at the sales, so let's take a look at some of the key KPIs for sales. First, we'll see automotive business production and sales. The left is the quarterly production graph. The right is the deliveries graph. Tesla entered a plateau starting from Q4 2023. If you look at the quarterly graphs, there are ups and downs, so you might feel like it's a big decline. However, demand isn't something you can strictly divide into periods like Q1 demand or Q2 demand. The reason is that sometimes demand is pulled in and consumed or pushed back. A representative example is last year's Q4. In last year's Q4, production was less than 2023 Q4, but sales were slightly higher. The reason is that due to the new Model Y launch, they went into clearance sales of old models at lower prices. Right now, unlike the sensational headlines for media, it's a gentle decline or growth plateau. Such phenomena are seen in other big tech companies too. For example, Apple. It's a phenomenon that occurs after a mega-hit product if no product surpassing it comes out. Tesla also has no successor to the best-selling car, Model Y. In terms of revenue, they expected this from Cybertruck, but as a pickup truck with a price positioning over $50,000, it's facing difficulties in volume expansion. You can confirm in the graph that there are two quantum jumps. One is a small quantum jump after Model 3 launch. The other is a big quantum jump after Model Y launch. Ultimately, to create another quantum jump, a new form factor is needed. Many people think that form factor is a low-end vehicle, but I see it as just a temporary measure. It's defensive, because Chinese EV companies also make low-end well, cheaply. The real new form factor is Cybercab. Something like Cybercab needs to come out to create another boom while being truly new. Cybercab's power is not just the model itself and autonomous driving, but from a sales perspective, diverse channels. It can be turned into B2B business, sold B2C to general people, or sold B2B. Rather, B2B side will be strong. In that case, from a sales perspective, it's less affected by seasonality, providing stability. In the case of energy storage deployment, variability is very high depending on the timing when contracts are piled up. Therefore, it's recommended to look at 12-month rolling data. The left is quarterly, the right is 12-month rolling graph. Energy storage has been in continuous growth after a quantum jump in Q2 2024 as Lathrop Megapack factory ramp-up completed. The trend is even clearer in the right graph. And waiting for the second quantum jump, Shanghai Mega Factory. Backlog is already continuously increasing, so once ramp-up completes, it's expected to become a production base for Asia, Oceania, and Europe. For energy backlog and revenue, I'll explain in detail in deferred revenue in balance sheet. For superchargers, the expansion speed of stations and connectors has slowed since H2 2023. The trend is visible in both left quarterly and right 12-month rolling. Instead, as Tesla has posted multiple times on X, we can see they are focusing on increasing utilization and quality. In recent postings, they said utilization reached 96%, and increasing turnover by shortening charging time per unit through high utilization and V4 version upgrades is very important for profitability improvement. Because the Q2 gross margin for the services business, which includes superchargers, is only 5.3%, improved from previous quarters' 3.8%, but very low compared to other businesses. But in services, the only business that can increase margins is charging. From this perspective, you can see why Tesla emphasizes this part so much. Also, utilization is expected to increase by opening superchargers to other brands. In fact, that effect appeared a little this quarter. I'll explain this in the gross margin section. Next is on cumulative basis. Looking at this, you can confirm that the fundamentals of the businesses currently driving Tesla, like autonomous driving, humanoid robots, are continuously strengthening. The only weakening fundamental would be if the trends in these slides flatten, but I haven't discovered such parts yet. Now, to summarize each business situation on a 12-month rolling basis. For energy business, it's showing high growth trends, and services are focusing on efficiency improvements, but still recording double-digit growth. Automotive entered negative growth on quarterly basis, but the reduced decline width from last quarter is encouraging. Let's look at gross profit, which many people are always interested in. Gross profit is largely influenced by automotive, which accounts for over 70%. It peaked in Q4 2022 and continued declining, but rebounded this quarter. The main reason for the decline start was price cuts or promotions from Q2 2022. In 2022, Tesla planned a paradigm shift in FSD technology, transition from existing rule-based to AI-based end-to-end. However, for E2E to properly demonstrate capability, training based on actual driving data is needed, and a certain level or more of real-life data is required. However, the timing to secure driving data through vehicle sales overlapped with interest rate hikes directly affecting car sales. Here, Tesla made a strategic choice. To secure driving data, they executed large-scale investment by borrowing the means of price cuts. Due to this, margins sharply declined, and gross profits started decreasing despite sales volume increases. However, we must not forget that because of this bold decision, we have the current FSD. And this price cut was an unprecedented type of investment. Need to invest as quickly and massively as possible, but due to price reductions, automotive margins continued to decline. From Q4 last year to Q1 this year, it fell to the 17% range. This quarter, it stemmed from the effect of the global simultaneous production strategy. They cleared out old models at reduced prices at the end of last year and reorganized the lineup with new models that can be sold at full price. Naturally, ASP rose. Moreover, energy business with around 30% high margins continues, and with revenue growth, its business proportion rose from 10% in the first half last year to 13% this year, contributing more to gross profit and partially offsetting automotive sluggishness. In terms of gross profit and margin, I see Tesla has now turned around. Of course, how quickly it returns to growth phase could be a wild card, but just creating a rebound trend is a good signal. Automotive profit and margin align with the overall Tesla results explained earlier, so I'll skip. This slide is an explanation of the investment strategy in automotive price cuts executed from 2022. As explained in the previous slides, Tesla maintained over 30% gross margin until Q1 2022, but as interest rates rose and people's purchasing power fell, they started price reductions. At the time, there were many opinions on the price policy, especially criticisms that it was a failed strategy as they abandoned the luxury brand image and profitability worsened. However, there was a hidden intention. It was a strategy to secure driving data. Unlike other data, driving data is literally data Tesla can obtain only if people buy Tesla vehicles and drive them. An asset not obtainable through general CapEx investment. But in 2022 at that time, Tesla's adjusted EBITDA reached 23.6% margin, even though they executed price reductions from Q2. One reason to look at adjusted EBITDA is that it excludes non-cash expenses, indirectly showing cash profitability from operations. Looking at the small table on the right, in 2024, Tesla's operating margin fell to 7.2%, but adjusted EBITDA is 17%, much higher than other auto companies. This is the result of the reason for executing price reductions. To summarize again, through large-scale investment called price reductions, Tesla started exploding in large-scale data for completing autonomous driving. In 2022 and 2023, with V10, 11, and in August 2023, first revealing E2E, then with V12 in 2024, FSD driving data exploded. Without the driving data accumulated in 2022 to 2023, probably couldn't achieve the current FSD modeling completeness so quickly. Many criticize profitability, but in my eyes, Tesla chose the future over current profitability. The strategic direction of investment for the future is continuing. I'll explain more about this in the operating expenses section. Positive and negative gross profit have been repeated until Q1 2022 when energy storage deployment achieved 1 gigawatt, turning gross profit positively. Since then, while energy storage deployment grew 10 times until now, gross profit grew 9 times. And it seems to continue high-speed growth ahead. For gross margin, it's properly showing the power of mass production. As Lathrop Megafactory went full operation, gross margin already reached mid-30%. Moreover, Shanghai Megafactory is in ramp-up. Usually during factory ramp-up, margins are low due to cost burden, but once Shanghai factory ramp-up completes, midterm gross margin could exceed 30%. Let's look at services gross profit and margin. As explained in revenue, from 2022, services sector, especially supercharger business, modified strategy from rapid expansion to enhancing service quality and efficiency. As a result, from Q1 2022, services sector gross profit turned black. Services sector gross margin is still in the 5% range, but showed a small rebound this quarter. Tesla cited supercharger opening as the main cause of the margin turnaround. By other brands' vehicles using it, if utilization increases, services sector gross margin could rise through volume increase without price reductions. In this video, while filming, I said to look at 12-month rolling indicators for clear trends. Looking at 12-month rolling gross profit graph, overall Tesla shows automotive decrease, energy rapid growth, services gentle growth. Per vehicle SP and sales volume indicators graph. This graph also similarly to explaining automotive from Q2 2022 price investment policy. This chart is the example to show the effect of the global simultaneous production strategy. I hope you read it. Left top graphs is total operating expenses. Operating expenses consist of bottom left SG&A and top right R&D expenses mostly. Tesla's operating expenses is continuously increasing trend, but looking closely, it's due to future investments. Looking at SG&A in detail, costs have been maintained between $1,200 to $1,400 million since 2013. This is an average 5% increase relative to revenue. Then the reason for increased operating expenses is R&D costs driven by AI infrastructure investment. What Tesla accurately expressed in 10Q is R&D investment for accelerating AI software vehicle platform sales growth. And an indirect indicator is depreciation costs in right bottom graph issued from cash flow. Tesla invested $1.1 billion last year. This year plans to invest $8 billion because of expanding AI infrastructure. Even though Tesla is facing short-term difficulties from decreased car sales and gross margin decline, Tesla continues future investments as a real-world AI company. Sales decrease, gross margin decrease, operating expense increase. All lead to declining operating profit and margin. This waterfall chart shows year-over-year and quarter-over-quarter variance. Biggest factor in year-over-year operating profit decline is auto gross profit decrease. But another noteworthy point is R&D expense increase driven by AI infrastructure investment. If Tesla reduced R&D investment to reap benefits, could improve business by over $500 million. In EPS terms, $0.15. But Tesla chose the future. In quarter-over-quarter graph, operating income was rebounded because of auto gross profit. As mentioned multiple times, new Model Y supply normalization led to deliveries increase, and ASP increase was main reasons for margin improvement. R&D costs keep increasing driven by AI infrastructure investment. While most people view Tesla's Q2 earnings negatively, I see them positively because the quality of earnings is improving. When you look at trailing 12-month graph at the left bottom, adjusted EBITDA are stable since 2024 unlike operating income. Margin as well. The graph below compares net income and adjusted EBITDA. There's a reason for comparing these two metrics. It's during transitional periods in the business. For example, when investments have been made for the future but haven't yet translated into revenue. The biggest difference between EBITDA and net income is depreciation/amortization, D&A, which is whether these costs are excluded from earnings or not. So, why is EBITDA important? It's because it allows us to view earnings from the perspective of cash profits and focusing solely on the revenue and cost structure related to current operation. The left graph compares amounts on a 12-month rolling basis, while the right graph compares quarterly margins, profit rates. Looking at the left graph, on a 12-month rolling basis, net income continues to decline, but adjusted EBITDA, which excludes D&A, has remained at the same level for several quarters. The reason is depreciation. So, why has depreciation, which is the largest component of the difference between adjusted EBITDA and net income, increased? It's due to AI infrastructure investments. However, revenue related to AI infrastructure investments hasn't been substantial yet. Therefore, the fact that adjusted EBITDA, earnings excluding these related depreciation costs, maintains a similar scale despite declining revenue means that profitability is improving. Looking at the right graph, net income margin declined 1% year-over-year, but adjusted EBITDA margin rose 0.7%. In the previous quarter, both metrics declined year-over-year, but the decline in adjusted EBITDA margin was smaller. This indicates that the quality of earnings has been improving, and starting this quarter, it's beginning to rebound year-over-year as well. This is due to price improvements and enhancements in the cost structure related to operation. The price improvements stem from minimizing the Osborne effect through simultaneous global mass production of the new Model Y, and the cost structure improvements come from the restructuring carried out last year. Once this period passes and the fruits of the investments translate into revenue, both net income and adjusted EBITDA will trend upward. Let's look at the balance sheet. In the balance sheet, we will focus on evaluating financial soundness, especially current ratio, quick ratio, debt ratio, equity ratio, debt-to-equity ratio. So first, current ratio. Current ratio is current assets divided by current liabilities, an indicator evaluating company liquidity. Tesla Q2 2.04, average of 16 auto manufacturers 1.56, top level. Usually above 1.0 is considered very healthy. Tesla current ratio should be highly evaluated. In right chart, comparing big tech 7 companies, Tesla is top level except NVIDIA. Next, quick ratio, current assets minus inventory divided by current liabilities. Like current ratio, liquidity evaluation indicator, more strict. Tesla debt ratio 1.5, usually above 1.0 considered very healthy. Also better than 0.71. In right chart, comparing big tech 7, it's mid-upper tier. Third indicator, debt ratio, liabilities divided by total assets. You've probably heard this the most. Tesla's debt ratio is 0.39 and 0.50 or below is considered good. Average of 16 auto manufacturers is 0.45, and comparing big tech 7, it's also great. Equity ratio. Equity divided by total assets. Higher is always better. Tesla's equity ratio is 0.60, much higher than average of 16 auto manufacturers 0.35. Tesla's debt-to-equity ratio is 0.09. The average for 16 listed automobile manufacturing companies is 0.82, and second rank among big tech. Apple needs caution on financial stability. The reason is its financial policy, because Apple intentionally raises leverage despite of a lot of cash on hand. This table combines big tech 7 financial soundness ranking. These aren't absolute indicator, but basically what I want to convey is Tesla is top level of financial soundness. Tesla's inventory days in Q2 is 24 days, increased by 2 days compared to Q1. The reason is that Q2 was the final stage of ramping up the new Model Y. As production speeds reach their peak, inventories statistically increase. Having a lot of undelivered inventory at the end of quarter is normal. Also, based on Cox Automotive data, the U.S. average inventory days at the end of June is 82 days, which is 3.4 times that of Tesla. Tesla maintains its inventory at a healthier level. First off, deferred revenue basically means money Tesla has already collected from customers but can't recognize as revenue yet because they haven't fully delivered the product or service. I will split deferred revenue into 2 big buckets, the automotive side and the energy storage side, since they work differently. Starting with automotive, this is where things like full self-driving FSD features come in. In Q2, the balance hit $3.75 billion. That's a solid chunk. But check this out. When you look at the graph for FSD versions up to V10, V11, and V13, inflow the automotive deferred revenue, the green line, isn't keeping pace with the text development. It's actually flatlining. Why? Well, in the Q2 earnings call, Elon mentioned that half their owners don't even bother trying FSD. Tesla's got to figure out how to ramp this up. Flipping to the energy storage side, this is where it gets exciting. Q2 deferred revenue here was $2.1 billion, and the graph shows insane growth compared to last year. It's scary how fast it's climbing. But here's the teaser for the second half. Tesla has a massive pile of contract obligations, totaling $10.38 billion, with $5.47 billion expected to turn into recognized revenue within the next year. When I dug into last year's Q210Q for comparison, it's double the growth. Mind-blowing. No wonder the presenter says, "Don't worry about energy's future." Just the Shanghai megafactory alone screams success for Tesla. Overall, deferred revenue is like a crystal ball for Tesla's upcoming earnings. Automotive is a bit stuck due to FSD adoption issues, but energy is on fire with all those backlogs. The next group of slides is all about free cash flow, FCF. That's operating cash minus CapEx. Basically the cash left over after Tesla spends on growth. In the 12-month rolling free cash flow line chart, since 2019, free cash flow climbs steadily to a high of over $10 billion in 2023, dips a bit to $8 billion in 2024, and is climbing again in 2025. Even though Tesla is investing a lot of cash in AI infrastructure this year, as well as last year, their free cash flow is at the stage of recovery. I always recommend this TTM view because it cuts through the noise from quarterly variance. Accumulated free cash flow line. This cumulative view is motivating. From negative territory in 2019, it crosses zero in 2021 and shoots up to by $16 billion in Q2 2025. The line gets steeper post 2021 thanks to Model Y volumes and energy profits. It's like watching Tesla evolve from a cash-hungry startup to a self-sustaining giant. Shifting gears to cash balance slides. This slide is the cash balance line chart from 2010 to now. Cash balance exploded to $20 billion by 2022. It hovers between $15 to $25 billion in 2023 to 2024, landing at $16.7 billion in Q2 2025. Steady growth here means Tesla has a nice cushion for volatility, and with high interest rates, borrowing isn't appealing anyway. This is year-over-year cash balance waterfall chart. The beginning balance of cash was $15.4 billion. This was followed by $15.8 billion in inflows driven by operating activities and $10.2 billion in outflows for CapEx on AI infrastructure, resulting in a net positive cash flow. Finally, Tesla ended with $16.7 billion in cash on hand. We've confirmed Tesla's transitional phase through the comparison of EBITDA and net income. The stable cash flow stands out even amid declining revenue. Cheering on Tesla's AI transition. See you in the next quarter for 10Q Story. Share your thoughts in the comments.